May 4th, 2025. The end of an era. Warren Buffett officially steps down as chairman of Berkshire Hathaway. No press tour, no dramatic farewell, just one sentence in an annual meeting.
I have no intention, zero, of selling one share of Berkshire Hathaway. It'll get given away gradually.
But what it marks is the final chapter of one of the greatest financial stories ever told. This isn't just about stocks, or dividends, or returns. It's about a man who rewrote the rules of investing, then handed them off. Today, we're unpacking how Buffett built an empire and why stepping away might be his most strategic move yet. And at the end, we'll ask the one question every investor is now facing. What do we do without the Oracle? Before he was the Oracle of Omaha, Warren Buffett was a kid with a calculator for a brain and a hunger for numbers. At age 11, he bought his first stock, 3 shares of City Service Preferred, only to sell it too early for a small profit. The stock later soared, teaching him his first lesson, patience. By 14, he had filed his first tax return, claiming deductions for his bicycle and watch as business expenses for his paper route. Buffett wasn't just precocious, he was relentless. He devoured books like 1,000 Ways to Make $1,000 and was captivated by the idea of compound interest. In 1956, at 25, he started Buffett Partnership Limited with $105,000 from family and friends. Over the next decade, he averaged annual returns of 29.5%, nearly double the S&P 500. But his most pivotal move came in 1962, when he began buying shares of a struggling textile company called Berkshire Hathaway. By 1965, he took control not for its textiles, but as a vehicle to acquire other businesses. Buffett's strategy was simple: buy undervalued companies with strong fundamentals, hold them long-term, and let compounding do the work.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
His early investments included insurance companies like National Indemnity and Geico, providing a steady stream of cash known as float to fund further acquisitions. Buffett's disciplined approach and keen eye for value transformed Berkshire Hathaway into a conglomerate worth over $1.2 trillion today. His lesson? Patience, discipline, and a long-term perspective are the cornerstones of building lasting wealth. Berkshire Hathaway gave Buffett the vehicle, but it was discipline that gave him the edge. After taking control of the company, Buffett didn't try to reinvent himself. He doubled down on the same principles he'd followed since he was a teenager: patience, value, and conviction. In 1988, while Wall Street chased tech stocks and overseas growth, Buffett made what many called a boring move. He quietly started buying shares of Coca-Cola. By the end of 1989, Berkshire Hathaway had spent over $1.3 billion, roughly 35% of its entire portfolio, on a soft drink company. Analysts scoffed. But Buffett saw more than soda. He saw brand dominance, global reach, and pricing power. Coke wasn't just a beverage. It was a habit, a symbol, a machine that could compound cash for decades. By the late 90s, that single investment had returned over 5 times its original value. And Buffett's Coke play became a textbook example of his doctrine. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But just as Coke was climbing, the market was turning irrational. The dot-com era had begun. From 1995 to 2000, tech stocks surged by 400%. Startups with no revenue were worth billions overnight. Buffett? He stayed out. No Amazon, no Yahoo, no Netscape. Just newspapers, railroads, and bricks-and-mortar businesses people thought were already obsolete. Critics called him washed up. CNBC segments wondered if the Oracle had lost his touch. But then came 2000. The Nasdaq crashed 78% in 2 years. Companies vanished. Fortunes evaporated. Buffett, who never joined the party, never had to leave it. Berkshire's book value kept growing, and Buffett's caution was suddenly seen not as fear, but foresight. His lesson? The crowd is often loudest right before it's wrong. Buffett's success wasn't just about what he brought. It was about what he refused to touch. By the time Warren Buffett turned 80, Berkshire Hathaway wasn't just a company. It was an institution. Over 60 subsidiaries, hundreds of billions in assets, and shareholders who treated the annual meeting like a pilgrimage to Omaha. But behind the scenes, Buffett was facing a question no balance sheet could answer. What happens when the oracle leaves the room? He'd built Berkshire in his image. Rational, conservative, obsessively long-term. But even Buffett couldn't beat time. And for years, he dodged the succession question with humor. My successor is younger, better looking, and will cost less, he joked in 2010. But the clock was ticking. In 2018, after much speculation, Buffett finally named Greg Abel, a soft-spoken Canadian who ran Berkshire's non-insurance businesses, as the likely heir. Abel wasn't flashy, but that was the point. He understood capital allocation. He earned Buffett's trust. And perhaps most importantly, he knew when not to act, an underrated skill in a world addicted to noise. Behind the scenes, Buffett tightened the ship. He reduced share buybacks, increased cash reserves, and kept the business diversified enough to outlive any single leader. But he wasn't done making moves. In 2020, at age 90, Buffett spent $35.5 billion on Dominion Energy's natural gas assets. In 2022, he doubled down on Occidental Petroleum, quietly acquiring a stake that could lead to full control. These weren't random trades. They were legacy plays, bets on cash flow, infrastructure, and energy stability in a world shifting away from hype. And then, in May 2025, the news broke.
This running shows in American capitalism is coming to an end.
Warren Buffett, the CEO of Berkshire Hathaway, announcing his plans to step down as the CEO of the empire he built at the end of the year.
Warren Buffett officially stepped down as chairman. No press tour, no ceremony, just a line in the annual meeting that marked the end of an era. He didn't just build an empire, he designed its future. Markets don't just react to numbers, they react to narratives. And for decades, Warren Buffett was the narrative. When the dot-com bubble burst, people turned to him for calm. When Lehman Brothers collapsed, they waited for his next move. Even during COVID, a single investment from Buffett could move entire sectors. So what happens when the most trusted voice in finance goes quiet? Buffett stepping down didn't crash markets. It didn't trigger panic. But it did mark something deeper, the end of a certain kind of clarity. Because Buffett wasn't just a CEO, he was a compass. He believed in cash over hype, simplicity over complexity, businesses over buzzwords. While the world chased crypto, SPACs, and meme stocks, Buffett kept buying railroads, utilities, and insurance. Now that compass is off the board, investors are watching Greg Abel closely. He's competent, respected, but he's not Buffett. No folksy letters, no punch one-liners, no annual Q&A watched like the Super Bowl. Buffett's absence leaves a vacuum, not just at Berkshire, but in the entire value investing community. Because for years, his discipline served as a guardrail, a quiet reminder that you don't need to swing often, just smart. Now, the guardrails are gone. The market will move on. But the question is, will it remember what he stood for? Warren Buffett didn't leave behind a stock tip. He left behind a system. Buy what you understand, avoid what you don't. Be greedy when others are fearful, and above all, wait. That's the paradox of Buffett. He built his fortune not by acting often, but by refusing to act when others couldn't sit still. His genius wasn't prediction, it was restraint. He didn't chase bull runs, he survived them. Buffett proved that long-term wealth doesn't come from timing the market. It comes from understanding it, trusting it, and outlasting its chaos. Now he's gone, but the playbook isn't. It's there in every value fund that waits for real margin of safety, in every investor who skips the shiny stock to buy the boring business, in every shareholder letter that chooses honesty over hype. Buffett didn't just build an empire, he built a philosophy, one so durable it no longer needs its founder to function. And maybe that was the final move all along. If you've made it this far, you already understand. This wasn't just a story about Warren Buffett. It was a story about time, about how one man used patience like a weapon and built something that didn't need his name to survive. The markets will keep moving. CEOs will come and go. But the system he built, slow, simple, and brutally effective, still stands. So the question isn't what happens now that Buffett's gone? It's what do we do with the blueprint he left behind? If you want more stories like this, deep dives into the strategies, the turning points, and the people who move markets, subscribe and tell us in the comments who should we break down next. Because the empires may change, but the game never stops. This is Bedlam Bear. We'll see you in the next one.